Welcome to CFA Learning Study Reading. Working Capital Finance. The management of cash is the final part of working capital management. The cash needs of an organization can be determined using a cash flow forecast, and this will allow a business to plan how to deal with expected cash flow surpluses or shortages. Cash flow forecast. A detailed forecast of cash inflows and outflows incorporating revenue and capital items. Clearly laid out with references to workings. Depreciation is not a cash item. Reasons for holding cash. Transactions motive to meet regular commitments. Precautionary motive to maintain a buffer for unforeseen contingencies. Speculative motive to make money from a rise in interest rates. Losses, asset replacement problems. Easing cash flow problems. Postponing capital expenditure. Accelerating cash inflows. Selling non-essential assets. Longer credit. Rescheduling loan repayments. Treasury. Investing surplus management cash. Treasury management. Treasury departments are set up to manage cash funds and currency efficiently, and make the best use of corporate finance markets. The main advantages of centralized treasury management are avoiding a mix of surpluses and overdrafts, and being able to obtain favorable rates on bulk borrowing, investment. Centralized treasury management, decentralized treasury management. Improve exchange risk management, finance matches local assets. Employ experts. Greater autonomy for subsidiaries. Smaller precautionary balances required. More responsive to operating units. Focus on profit center. No opportunities for large sum speculation. Cash flow. Treasury cash management, investing surplus. Working capital management models, cash funding strategies. May be difficult to predict amounts. Q is the total amount required and no buffer to be raised to cash is allowed for. Provide for S when cash balance reaches upper limit. Firms buy securities to return cash balance to return point, normal level. When cash balance reaches lower limit, sell securities to return point. Return point equals lower limit plus 1/3 times spread. Set lower limit for cash balance. 3. Ascertain interest rate and transaction cost. Treasury management. Investing surplus cash appears twice, once as an input arrow and once in a shaded box. Considerations. Liquidity, profitability, safety. Instruments. Treasury bills. Term deposits. Certificates of deposit. Sterling commercial paper. Investments. New projects or acquisitions. Long-term cash surpluses may be financing, repay debt, buy back shares, used to fund dividends. Working capital investment policy. Characteristics. High levels of working capital. High financing cost. Reduced risk of system breakdown. Possible inventory obsolescence and lack of flexibility to customer demand. Moderate policy. Aggressive policy. Characteristics. Low levels of working capital. Aim to increase profitability by reducing financing cost. Increased risk of system breakdown and loss of goodwill. Easier with modern manufacturing techniques. Policy A. Conservative, permanent and some fluctuating current assets are financed out of long-term sources. This approach may lead to surplus cash available for investment during periods when fluctuating assets are at their lowest. Policy B. Aggressive, all fluctuating current assets and some permanent current assets are financed out of short-term sources. This policy carries a higher risk of possible liquidity problems, especially if short-term sources become unavailable or expensive. Policy C. Moderate, matching, long-term sources finance permanent assets, non-current assets plus permanent current assets. Short-term sources finance non-permanent assets, fluctuating current assets. This approach aims to match the maturity of assets with the maturity of their financing sources. Thanks for watch, like and subscribes. Soon Chapter 7, Investment Decisions.